The digital dollar trap. Inside the federal plan to erase cash by 2026. December 12, 2023. A Tuesday. A quiet market day. Nothing unusual until 2:14 p.m. when a filing appeared on the Federal Reserve's internal notice system. A line item so small, so technical that almost nobody noticed it. But those who did, froze. It was a reference to Pilot Expansion Directive, Retail Settlement Layer, Phase 2. Phase 2. A program that on paper shouldn't have existed yet. A program that analysts believed was years away. A program tied to a single phrase, Central Bank Digital Dollar, 2026 Readiness. This wasn't a rumor, not a speech, not a theoretical future of money white paper. This was a directive, a countdown, a signal that the system you rely on, the system you trust to store your savings, your income, your future, had already crossed the point of no return. Because in that moment, buried inside bureaucratic language and quiet timestamps, the Federal Reserve made one thing undeniably clear. Cash is no longer part of the plan. And if you think this is exaggeration, consider the number that triggered the alarm. 466 billion. That's the amount of physical currency currently circulating in the US banking ecosystem that cannot be digitized, tracked, or controlled. And according to the architects of this new system, that is 466 billion too much. You're watching a trap close, slowly, silently, but with mathematical inevitability. And like every historic financial trap, the danger is never when the system breaks. It's when the system begins to transition. Because transitions hide the truth. Transitions disguise the power shift. Transitions make the collapse look like innovation. But make no mistake, the digital dollar is not innovation. It is replacement. It is elimination. It is the death of the financial world you grew up in. And to understand how we got here, you must go back, not a decade, not a generation, but nearly 100 years, to a moment when cash itself barely survived extinction. Historical flashback, the pattern that never stops repeating. The year was 1933. America was suffocating under the Great Depression. Banks were collapsing. Savings evaporated in days. And then, one morning, people woke up to a headline that seemed impossible. Executive Order 6102, Confiscation of Gold. A single stroke of a pen erased the financial foundation of millions. Gold, the ultimate store of wealth, was no longer yours to hold. The government needed control. The system needed obedience. The crisis needed sacrifice. And the American public, out of fear, complied. Fast forward to 1971. Richard Nixon severed the world from gold permanently. The dollar was unbacked, unanchored, unrestricted. From that moment on, cash wasn't a store of value. It became a tool, a lever for governments, a mechanism for banks, a pressure valve for inflation. You see the pattern yet? In every crisis, in every transition, in every new system, money doesn't evolve. It gets redefined. And the public gets trapped. 1933. They eliminated your gold. 1971. They eliminated the gold standard. 2026. They eliminate your cash. Only this time, the plan is far more sophisticated. Because this time, they don't need a pen or a speech or an emergency declaration. They only need software. The hidden mechanism. The machinery behind the digital dollar. Most people think the digital dollar is a simple idea, a new digital version of money backed by the Fed. But that's not what this is. Not even close. This is a multi-layered control architecture decades in the making. And to understand it, you must see the mechanism buried beneath the surface. Layer 1, the settlement grid. The FedNow system launched in 2023 wasn't a convenience feature. It wasn't about faster payments. It was the construction of a permanent, always-on, centralized settlement engine, one capable of replacing retail banks entirely. Layer 2, Identity sync. Integrated into the back end is a mechanism for synchronized identity verification, linking bank accounts, digital wallets, tax IDs, behavioral profiles, transaction fingerprints. This is the compliance layer. You can't separate money from identity once this goes live. Layer 3, programmability. This is the heart of the trap. Digital dollars are not like cash. They can expire. They can be restricted. They can be paused. They can be redirected. Every dollar becomes a command. Layer 4, obsolescence of physical cash. The reason the 2026 directive matters is because of one phrase tucked inside. Physical currency remains incompatible with programmable policy implementation. In simple terms, cash cannot be controlled. Cash cannot be tracked. Cash cannot be limited. Therefore, cash must disappear. This isn't speculation. This is written across Basel III liquidity rules, Fed modernization plans, and Treasury digital transformation documents. The US financial system is building a framework where cash becomes friction, and friction is no longer allowed. Present-day trigger, the warning signs. You weren't meant to see. The shift isn't coming. It has already begun. Look at the data. Banknotes in circulation are shrinking. From 2020 to 2023, the percentage of large denomination bills entering the system dropped at the fastest rate since WW2. ATMs are disappearing. Over 14,000 were removed in just 3 years. Banks claim operational efficiency. But the truth is simpler. You can't transition to a digital dollar if cash withdrawals remain easy. Deposits are being consolidated. 4 major banks now control over 50% of all US deposits. Why? Because centralization is a prerequisite for conversion. Treasury is rewriting the definition of legal tender. Not loudly, not publicly, but through incremental revisions buried inside compliance updates. And then, there are the numbers that shouldn't exist. $1.2 trillion in reverse repo usage during periods when liquidity should have been abundant. This is the telltale sign of a system preparing to rewire itself. But the most damning signal happened quietly in September. A private meeting between Federal Reserve architects, Treasury digital currency planners, banking lobby executives, where a single statement leaked from the room: cash is transitional. Think about that. Transitional, not permanent, not stable, not part of the future. Cash is a temporary stage on the way to a fully digital system. A system where every dollar has a serial number. Every serial number has a location. Every location has a purpose. Every purpose has a permission level. And that means one thing: you are no longer in control. The trap. Why the system cannot turn back. A digital dollar would be dangerous by itself. But the real danger is this: once the transition begins, it cannot stop. Because the moment the system becomes digital, physical cash becomes a loophole, a threat, an escape route. The government cannot allow 2 parallel systems to coexist. Not when one is programmable and the other is uncontrollable. This is why the 2026 date matters. This is why the filings matter. This is why the numbers matter. The trap looks like this. Step 1. Reduce cash access. Fewer ATMs. Fewer bank branches. More out-of-service notices. More withdrawal limits. Step 2. Incentivize digital faster payments. Instant refunds. Tax benefits for digital compliance. Step 3. Penalize cash, higher fees. Reporting requirements. Suspicious activity flags. Step 4. Restrict cash purchase limits. Daily cap enforcement. Withdrawal approvals. Step 5. Replace cash automatic conversion. Digital wallet issuance. Mandatory digital benefits. By 2026, this becomes irreversible. This isn't fear. This isn't speculation. This is mathematical reality. The US financial system has reached the end of its old architecture. The next architecture demands total control. The digital dollar trap, inside the federal plan to erase cash by 2026. The trap has been set. The architecture is already in motion. But to understand what comes next, to understand why 2026 is being treated as a deadline, not a theory, you need to step deeper inside the machinery. Because beneath every public speech, every press release, every innovation pilot, there is a shadow economy of numbers, ratios, spreads, and filings that reveal the real truth. The digital dollar isn't a plan. It's a necessity. The current system mathematically can't survive without it. And the people controlling the system know it. The hidden pressures, the liquidity crisis, no one is talking about. There's a myth floating across financial media that the banking system is stable, that liquidity is adequate, that stress tests show resilience. But here's the number that destroys that narrative. $3.3 trillion. That's how much commercial bank deposits have vanished since 2022. Silently, quietly, without headlines, without panic. A historic outflow hidden behind technical language like deposit reallocation and balance sheet optimization. But the truth is simple. People are moving money out of banks, into money markets, into treasuries, into anything that looks safer than a traditional deposit. And banks are suffocating because of it. Because banks don't hold your money. They leverage your money. They multiply it. They stretch it across loans, derivatives, and liquidity obligations so fragile that even a 5% withdrawal shock can break them. Now imagine trying to maintain that model in a world where cash remains untraceable, uncontrollable, and unprogrammable. The banking system cannot function with modern leverage ratios and an unmonitored, unregulated cash economy. And that brings us to the number that terrifies policymakers more than inflation, unemployment, or recession. $96 trillion. The total derivative exposure tied to settlement obligations that rely on instantaneous liquidity. The current system can't support that level of exposure without total control of the currency rails. Because cash is a blind spot, a hole in the map, a gap in the surveillance grid. The digital dollar closes that gap, perfectly, permanently. The parallel system. The comics warning. Nobody understood. To understand the future, look at the metals market, not the price, the mechanics. COMEX runs a dual system. Paper contracts, physical delivery. Most traders live in the paper world, but insiders know the truth. The system only works if people don't ask for physical. Because if too many people demand real metal, not contracts, the system collapses. And that's exactly what happened in 2020. Delivery demand surged. Vault inventories dropped. Margins blew open. The COMEX model nearly snapped. Now, pause here. Ask yourself, what is cash? Cash is physical. Cash is deliverable. Cash is the real metal of the banking system. And the digital dollar? It's the paper contract, infinitely issued, infinitely programmable, infinitely controllable. The exact same trap, the exact same structure, the exact same vulnerability. If too many people demand physical cash at the same time, the system breaks. And guess what? It already happened. The bank run they won't admit happened. March 2023, a warning shot, Silicon Valley Bank. Signature, First Republic. Most people think these were isolated failures, symptoms of bad management, bad duration hedges, bad risk modeling. Wrong. The truth is much darker. These banks didn't fail because people pulled deposits. They failed because the system couldn't deliver cash fast enough. A modern bank run isn't a line of people at the door. It's billions moving digitally in minutes. And in March 2023, during peak withdrawal pressure, the Federal Reserve quietly increased lending to banks through the BTFP program at a rate nobody expected. $150 billion in emergency liquidity in days. This was not intervention. This was triage. And the aftermath revealed something chilling. A system with digital withdrawals and physical settlement constraints cannot survive another shock. Unless the physical element disappears, unless cash becomes obsolete, unless every dollar becomes digital. This isn't theory. This is survival. The real reason for 2026, Basel III's unspoken deadline. You cannot understand the digital dollar timeline without Basel III. Everyone talks about liquidity coverage ratios, net stable funding ratios, high-quality liquid assets. But buried inside the reform is a single structural change. By 2026, banks must meet liquidity standards that are mathematically impossible with the current cash-based system. Cash counts as HQLA, but cash withdrawals destroy HQLA. This paradox means the more people use cash, the harder it becomes for banks to meet Basel III compliance. You are watching a countdown created by regulation, not policy speeches. 2024, preparatory reporting. 2025, compliance integration. 2026, enforcement phase. And here's what nobody is saying publicly. The digital dollar allows regulators to freeze, throttle, or redirect liquidity in real time. Basel III cannot function cleanly without that power. 2026 isn't a forecast, it's a requirement. The political cover. How crisis creates opportunity. In every transition, every monetary pivot, there must be a narrative, a story, a justification, a crisis large enough to make the population accept the unacceptable. 1933 had the Great Depression. 1971 had inflation and international imbalance. 2008 had systemic collapse. So what will justify the digital dollar? The clues are already visible. Rising fraud numbers. Every agency is reporting higher than average cash-related crime, even though cash usage is falling. Tax gap warnings. $688 billion in uncollected taxes is being tied to unreported cash activity. Illicit finance claims. Reports increasingly frame cash as the preferred medium of criminal networks. National security language creeping into Treasury filings. Do you see the pattern? The justification will not be convenience. It will be safety, security, stability. The public will be told, cash helps criminals. Cash enables tax evasion. Cash hides transactions. Cash empowers corrupt networks. Cash threatens national resilience. Then the solution will be delivered. A secure digital dollar for a safer economy. And millions will accept it. Because fear always opens the door for change, just like it has for every monetary revolution before. The mechanics of control. How digital dollars will replace cash in practice. The shift will not happen in one announcement. It will be phased, coordinated, engineered. Here is how the conversion will actually unfold. Phase 1. Soft replacement. Digital wallets offered by banks as optional. Government benefits paid digitally for efficiency. Tax refunds digitally for speed. Phase 2. Incentive layer. Discounts for digital usage. Fee reductions. Priority services. Faster settlement. Phase 3. Restriction layer. Withdrawal caps. Reporting above low thresholds. Suspicious activity flags for cash-heavy behavior. Phase 4. Elimination layer. Banks begin removing cash services. Retailers stop accepting cash due to compliance burdens. ATMs shut down across the country. Phase 5. Mandatory compliance. All government payments digital only. All major banks convert accounts into digital wallets. Cash redemption periods announced with expiration deadlines. Phase 6. Final conversion. Old notes invalidated. Digital only, legal tender enforced. Cash becomes a relic. Non-functional, unrecognized, unredeemable. This is the path. It has been used in other countries, and it is already being tested here. 2026 isn't the start. It's the tipping point. The reality check. Why digital money means total dependency. People think digital currency just means online money. But programmable currency is fundamentally different. A digital dollar can expire, be deactivated, be frozen, be redirected, be restricted to certain purchases, be locked to a specific geographic zone, be limited to specific categories, be taxed automatically, be monitored at every point of use. your money becomes a rule written by someone else. With cash, you choose how you spend. With digital currency, your spending can be shaped by policy. With cash, you control access to your savings. With digital currency, access can be granted or denied instantly. With cash, privacy exists. With digital currency, privacy becomes a memory. A digital dollar gives the system absolute, unprecedented, real-time control. And once that system is activated, there is no going back. Not socially, not technologically, not politically, not economically. The transition is a one-way gate. The bank's incentive. Why big banks want cash, gone more than the government. This part shocks people. The public assumes banks want freedom and the government wants control. Wrong. The banks want control too, but a different kind. Here's why. Cash does not generate fees. Cash does not generate data. Cash does not generate analytics. Cash does not lock customers into platforms. Cash does not produce transaction revenue. Digital dollars, however, create permanent transaction flows, create perfect behavioral data, create monetizable spending patterns, create programmable products, create a captive user base. For major banks, a digital dollar ecosystem is a gold mine. They don't have to hold vaults. They don't have to manage cash transport. They don't have to deal with ATM networks. They earn revenue simply because the system exists. This is why the largest US banks are lobbying for digital settlement layers, digital identity rails, digital onboarding tools, and programmable money infrastructure. This is their new business model, and they are aligning with the Federal Reserve to ensure it becomes reality. The turning point, the shift you will feel before 2026 arrives. The public always sees the symptoms last, but you will begin feeling the change through shorter bank hours, higher ATM fees, ATM outages, withdrawal questions, cash purchase flags, increasing identity checks, digital onboarding pressure, cash inconvenience language. These are not random. These are the early tremors before the structural break. Because the system can only move in one direction now, toward total digital control. And the people running the system are accelerating. The digital dollar trap. Inside the federal plan to erase cash by 2026. You've seen the signs. You've watched the phases. You've felt the pressure building. But part 3 will take you into the end game. The mathematics, the timelines, the inevitability, and the future that has already been written beneath your feet. This is where everything you've learned so far snaps together, where the final pieces of the trap reveal themselves, where the digital dollar stops being a theory and becomes a countdown. Because in every monetary revolution, there is a moment, an irreversible pivot, where the system transitions from stable to unrecoverable. For this one, that moment is approaching. Faster than the public realizes, faster than the banks admit, faster than policymakers can disguise. And it all begins with a single mathematical truth. A system based on uncontrolled cash cannot survive a world built on programmable liquidity. The math of the endgame. Why cash must die for the new system to live. At first glance, cash seems harmless. A piece of paper, a relic, a convenience. But to the architects of the digital dollar, cash is the enemy of control. And the enemy of control is the enemy of the system. The math looks like this. 1. Cash has no real-time traceability. You cannot track it. You cannot throttle it. You cannot weaponize it with policy. 2. Cash prevents full liquidity synchronization. To run a digital-first, real-time, compliance-obedient economy, the Federal Reserve needs every dollar to respond immediately. Cash cannot do that. 3. Cash creates settlement blind spots. It blocks instant reporting. It blocks dynamic taxation. It blocks programmable compliance. 4. Cash disrupts leverage models. Every dollar withdrawn destroys multiple layers of bank leverage. No digital system can run while physical drains exist. But the most important, 5. Cash keeps people free. And a system that requires total liquidity control cannot allow freedom inside the currency layer. This is the core, the unspoken truth, the reason 2026 matters. Because by 2026, the old system hits its mathematical limit. Liquidity rules tighten. Settlement windows shrink. Leverage models strain. Basel III enforcement becomes non-negotiable. And with each tightening screw, the digital dollar becomes less of a choice and more of a requirement. The compliance revolution. How CBDCs become mandatory without ever being announced. Most people expect a presidential speech. Ladies and gentlemen, today we introduce the digital dollar. That's not how this works. That's not how systems evolve. That's not how control functions. The digital dollar will not arrive with fireworks. It will arrive through compliance. Here's how the regulatory trap will tighten. 1. Anti-money laundering, AML. Updates. Cash-heavy behavior gets flagged as suspicious. Thresholds slowly lowered. Investigation triggers increase. Businesses stop accepting cash. Not because they want to, but because compliance costs become too high. 2. Know your customer, KYC, integration. Every financial service requires digital identity linkage. No ID, no account access. No digital ID, no digital wallet. No digital wallet, no legal tender. 3. Treasury reporting thresholds. Large cash deposits require justification. Large cash withdrawals require authorization. Banks get pressured to reduce manual handling. 4. IRS digital filing connectors. Tax compliance becomes automated. Digital income, digital deduction, digital refund. Cash income becomes suspicious by default. 5. Retail banking policy shifts. Banks reduce hours, reduce teleservices, reduce ATM fleets, increase digital onboarding nudges. 6. Government benefit migration. Medicare, Social Security, SNAP, tax refunds, stimulus, all paid digitally. Cash becomes impractical for millions. The digital dollar won't be announced. It will be imposed through architecture. People won't switch because they choose to. They'll switch because the world around them stops functioning without it. The real-world trigger. What will finally push the public into the digital dollar? Every system transition uses a catalyst, an event large enough to justify change. For the digital dollar, one of these events is likely. Scenario A, the 2024-2025 liquidity shock, a bank failure, a treasury market freeze, a repo market crack. Something that reveals how fragile the physical settlement system really is. In the aftermath, the message becomes, digital currency would have prevented this. Scenario B, the 2025 tax gap crisis. A historic deficit, a widening tax gap, a narrative that cash is enabling unreported income. The solution, we must modernize tax compliance with a digital dollar. Scenario C, a national security event, a cyber attack narrative, a cash-funded threat, a justification to eliminate anonymous transactions. The digital dollar becomes the safe option. Scenario D, inflation surge, behavioral controls. If inflation spikes again, programmable money becomes the ultimate policy weapon. Restrict spending limit categories, enforce savings control velocity. The digital dollar becomes the inflation solution. Any of these could be the spark, the justification, the psychological trigger, and policymakers are waiting for it. The 3 endgame scenarios, mathematical forecast. Every crisis has trajectories. The digital dollar has 3. These are not predictions. These are mathematical consequences based on liquidity, leverage, compliance, and regulation. Scenario 1, conservative transition, slow constriction, 2024-2025. Cash access becomes inconvenient. Banks reduce physical services. ATMs disappear at accelerating rates. 2026, digital wallets become the primary medium for government payments. Cash remains, but is deprecated. 2030, cash survives only in black markets and fringe regions. Digital compliance becomes normal. This is the slow choke, a quiet elimination. Scenario 2, moderate transition, crisis-assisted shift. 2024-2025, a small banking shock triggers liquidity panic. Withdrawal limits spread, cash shortages reported. 2026, the digital dollar is rolled out as the stabilization tool. Government announces a conversion window. Cash gradually invalidated. 2027-2028, paper currency usage collapses. Digital wallets dominate. This is the controlled demolition, managed, planned. Scenario 3, extreme transition, forced reset. A major event hits. Large bank failure, treasury market freeze, global liquidity seizure, geopolitical trigger, cyber crisis. The system panics. The old rails break. Cash becomes unavailable during the shock. The digital dollar is declared critical infrastructure. Mandatory conversion. Cash invalidated within months. This is the hard reset. Fast, total, permanent. Why there is no escape. Once the digital dollar arrives, the moment the digital dollar is introduced, everything changes. 1. Every transaction becomes traceable. Nothing is anonymous, not income, not spending, not transfers. 2. Every dollar becomes programmable. Your money can be limited, categorized, redirected, restricted. 3. Access becomes permission-based. Accounts can be throttled, frozen, locked. 4. Savings become conditional. Stored money can expire, or be taxed, or be repurposed. 5. Economic behavior becomes controllable. Spending patterns become adjustable. Policy becomes behavioral engineering. 6. Privacy disappears permanently. There is no offline, no unaligned note, no hidden reserve. 7. Cash, the last shield of autonomy, vanishes. And once it's gone, it doesn't come back, ever. Because systems of control never voluntarily weaken, they only strengthen. Once programmable money becomes law, the architecture becomes self-reinforcing. More data, more policy power, more control, more dependency, less resistance. This is the nature of digital systems. This is the nature of monetary evolution. This is the nature of the digital dollar trap, the world you will wake up to. You may not notice the change at first. Most people won't. The shift will feel like smoother payments, faster transactions, better convenience, more security. Modern features. Technology always hides the truth behind comfort. But slowly, quietly, you'll sense the difference. A declined purchase without explanation. A strange spending notification. A travel restriction triggered by geography. A flagged deposit. A frozen transfer. A request for identity confirmation to access your own money. A hard limit on weekly cash withdrawals. A store refusing cash entirely. And then, eventually, a silence. An absence. A world where cash simply doesn't exist. Where every dollar you earn, hold, or spend moves through a system designed not for you, but for the people who control the rails. A world where compliance replaces choice. Where digital rules replace personal freedom. Where currency becomes code. Where code becomes law. Where law becomes control. The digital dollar will not just change the economy, it will change society. Behavior, privacy, autonomy, human interaction, financial existence itself. This is the only direction the system can move now. The architecture is built, the incentives are aligned, the deadlines are set, the trap is closing, and the most chilling truth, most people will walk into it willingly, the pattern that always returns. If you study history, you'll notice a rhythm. Every few generations, money transforms. 1933, gold confiscated. 1944, Bretton Woods, 1971. Gold window closed, 2008. Global Liquidity Rewrite 2026. Digital dollar convergence. Each time, the pattern is the same. A crisis, a justification, a solution, a trap. The public never sees it coming. Not because they're blind, but because the system is designed to keep them comfortable until the moment of the shift. And here we are again, standing at the edge of another transformation. A moment that will be studied decades from now as the era when money became code, and the code became the cage. You are living through the final chapter of physical currency, a story that began centuries ago and ends within the next few years. Not with an explosion, not with a crash, not with chaos, but with silence, with efficiency, with compliance, with convenience. The digital dollar won't feel like a revolution. It will feel like an update. And that, right there, is the trap.